Welcome. Today, we're diving into a question on many investors' minds. Is Bitcoin still a safe investment in 2026? Over the past decade, Bitcoin has evolved from a niche digital currency to a mainstream financial asset. But as we look toward the future, especially in 2026, the landscape is shifting. In this video, we'll explore the factors influencing Bitcoin's safety as an investment, including market trends, regulatory changes, and technological advancements. Whether you're a seasoned crypto enthusiast or just curious about digital assets, this journey will help you understand the risks and rewards of holding Bitcoin in 2026. Let's begin by looking at Bitcoin's journey so far. Bitcoin was launched in 2009 by the mysterious Satoshi Nakamoto. In its early years, it was mostly used by tech enthusiasts and those interested in decentralized finance. The price was volatile, and mainstream adoption seemed far off. However, as the years passed, more people began to see Bitcoin as a potential store of value, similar to digital gold. This shift in perception laid the foundation for its growth. Understanding where Bitcoin started helps us appreciate how far it has come and sets the stage for evaluating its safety as an investment in 2026. Over the past decade, Bitcoin has seen a surge in mainstream adoption. Major companies, financial institutions, and even some governments have recognized its value. Payment platforms now support Bitcoin transactions, and investment funds include it as part of diversified portfolios. This widespread acceptance has contributed to greater liquidity and stability, though volatility remains. As we approach 2026, Bitcoin's integration into the global financial system is more robust than ever, making it a significant player in the investment world. One of the defining characteristics of Bitcoin is its price volatility. Even as adoption has increased, Bitcoin's price can swing dramatically in short periods. This volatility is driven by factors such as market sentiment, macroeconomic events, and regulatory news. For investors, this means potential for high returns, but also significant risk. In 2026, while some stabilization has occurred, Bitcoin remains more volatile than traditional assets like stocks or bonds. Understanding this volatility is crucial for anyone considering Bitcoin as a safe investment. Regulation plays a major role in Bitcoin's safety as an investment. In 2026, governments worldwide have taken varied approaches to cryptocurrency regulation. Some countries have embraced Bitcoin, providing clear guidelines and legal frameworks, while others have imposed restrictions or outright bans. These regulatory differences can impact Bitcoin's price and accessibility. For investors, staying informed about the regulatory environment is essential, as changes can quickly affect the safety and legality of holding Bitcoin. Security has always been a concern for Bitcoin investors. Over the years, technological advancements have made Bitcoin wallets and exchanges more secure. Multi-factor authentication, cold storage, and improved encryption are now standard. In 2026, these security measures have reduced the risk of hacks and thefts, but no system is entirely foolproof. Investors must remain vigilant and use best practices to protect their assets. Enhanced security contributes to Bitcoin's reputation as a safer investment, but risks still exist. As Bitcoin has matured, the market infrastructure supporting it has become more sophisticated. There are now regulated exchanges, futures markets, and a range of financial products built around Bitcoin. This maturity has attracted institutional investors and increased overall market stability. However, the market is still young compared to traditional finance, and unexpected events can cause rapid changes. In 2026, Bitcoin's market maturity is a positive sign, but it's important to remember that it's still evolving. Institutional investors have played a significant role in Bitcoin's evolution. Large investment firms, hedge funds, and even pension funds now allocate a portion of their portfolios to Bitcoin. This influx of institutional money has helped legitimize Bitcoin and provided additional liquidity. In 2026, institutional involvement continues to grow, offering a level of confidence for individual investors. However, large players can also influence price movements, so it's important to be aware of their impact. Bitcoin's underlying technology, blockchain, has seen significant improvements. Upgrades like the Lightning Network have made transactions faster and cheaper, while ongoing development aims to enhance scalability and privacy. In 2026, these advancements make Bitcoin more user-friendly and accessible. However, technology is always evolving, and new challenges can arise. Staying updated on technological changes is crucial for assessing Bitcoin's safety as an investment. A core principle of Bitcoin is decentralization. Unlike traditional currencies controlled by central banks, Bitcoin operates on a decentralized network of computers. This structure makes it resistant to censorship and government interference. In 2026, decentralization remains a key strength, providing a level of security and autonomy for investors. However, decentralization also means that there is no central authority to resolve disputes or recover lost funds, so users must take personal responsibility for their assets. Bitcoin's supply is capped at 21 million coins, making it a deflationary asset. This limited supply, combined with increasing demand, has historically driven up the price. In 2026, most Bitcoins have already been mined, and scarcity continues to play a role in its value. However, demand can fluctuate based on market conditions, investor sentiment, and macroeconomic factors. Understanding the dynamics of supply and demand is essential for evaluating Bitcoin's investment potential. Every 4 years, Bitcoin undergoes a halving event, reducing the reward for mining new blocks by half. This event decreases the rate at which new Bitcoins are created, further limiting supply. Historically, halvings have been followed by significant price increases. The most recent halving occurred in 2024, and its effects are still unfolding in 2026. Investors should be aware of how halving events impact Bitcoin's price and long-term investment outlook. Bitcoin's value is influenced by global economic conditions. Inflation, currency devaluation, and geopolitical instability can drive investors toward Bitcoin as a hedge. In 2026, economic uncertainty in various regions continues to make Bitcoin attractive to those seeking alternatives to traditional assets. However, economic recovery or stability can also reduce demand. Monitoring global trends is important for anyone considering Bitcoin as a safe investment. Despite improved security, hacking remains a risk in the cryptocurrency world. Exchanges and wallets can still be targeted by cybercriminals. In 2026, while major incidents have decreased, occasional breaches remind investors to use secure platforms and personal security measures. The decentralized nature of Bitcoin means that lost or stolen funds are often unrecoverable. Being proactive about security is essential for safeguarding your investment. The cryptocurrency space has seen its share of fraud and scams. Ponzi schemes, fake investment platforms, and phishing attacks have targeted unsuspecting investors. In 2026, regulatory oversight and public awareness have reduced the prevalence of scams, but new threats continue to emerge. Investors must remain cautious, verify sources, and avoid offers that seem too good to be true. Vigilance is key to protecting your Bitcoin investment. How you store your Bitcoin matters. In 2026, there are more options than ever, from self-custody using hardware wallets to third-party custodians offering insurance and regulatory compliance. Each method has its pros and cons. Self-custody provides control but requires technical know-how, while custodians offer convenience but introduce counterparty risk. Choosing the right custody solution is an important part of keeping your investment safe. Tax treatment of Bitcoin varies by country. In 2026, many governments have clarified how cryptocurrencies are taxed, but rules can still be complex. Investors may face capital gains taxes, reporting requirements, and even penalties for noncompliance. Understanding the tax implications of buying, holding, and selling Bitcoin is essential for avoiding surprises and ensuring your investment remains safe from legal issues. Bitcoin mining has faced criticism for its environmental impact due to high energy consumption. In 2026, the industry has made strides towards sustainability, with more miners using renewable energy sources. However, environmental concerns persist and can influence public perception and regulatory action. Investors should consider the environmental footprint of Bitcoin and how it might affect long-term safety and acceptance. Bitcoin is no longer the only game in town. Thousands of other cryptocurrencies have emerged, each with unique features and use cases. Some, like Ethereum, offer smart contracts, while others focus on privacy or speed. In 2026, competition is fierce, and new innovations could challenge Bitcoin's dominance. Investors should keep an eye on the broader crypto landscape when assessing Bitcoin's safety and long-term potential. Bitcoin's network is constantly evolving. Upgrades and forks can introduce new features or improve security, but they can also create uncertainty. In 2026, recent upgrades have focused on scalability and privacy, making Bitcoin more efficient. However, disagreements within the community can lead to splits, as seen in past hard forks. Understanding the implications of network changes is important for investment safety. Liquidity refers to how easily you can buy or sell Bitcoin without affecting its price. In 2026, Bitcoin enjoys high liquidity on major exchanges, making it easy for investors to enter or exit positions. However, during periods of extreme volatility, liquidity can dry up, leading to sharp price movements. Understanding liquidity risks is an important part of evaluating Bitcoin's safety as an investment. Bitcoin is more accessible than ever in 2026. Users can buy, sell, and store Bitcoin through a variety of platforms, including mobile apps and traditional financial institutions. This accessibility has broadened Bitcoin's appeal and made it easier for new investors to participate. However, ease of access also means that inexperienced users may be exposed to risks if they don't understand the technology or market dynamics. Public perception of Bitcoin has shifted over the years. Once seen as a tool for illicit activity, it's now recognized as a legitimate asset class. In 2026, media coverage, celebrity endorsements, and educational efforts have improved Bitcoin's image. However, negative news or high-profile incidents can still sway public opinion and impact price. Investors should consider how perception influences market behavior. Legal risks remain a concern for Bitcoin investors. Changes in laws or enforcement actions can affect the ability to buy, sell, or use Bitcoin. In 2026, most major economies have established legal frameworks, but uncertainty persists in some regions. Investors should stay informed about legal developments and ensure compliance to avoid potential losses or penalties. Macro trends such as digitalization, financial innovation, and changing consumer preferences have supported Bitcoin's growth. In 2026, these trends continue to shape the investment landscape. As more people become comfortable with digital assets, Bitcoin's role as a portfolio diversifier and hedge against traditional risks is reinforced. Understanding macro trends helps investors anticipate future developments and assess safety. Many investors use Bitcoin as a way to diversify their portfolios. Its low correlation with traditional assets like stocks and bonds can help reduce overall risk. In 2026, financial advisors often recommend a small allocation to Bitcoin for diversification purposes. However, the right allocation depends on individual risk tolerance and investment goals. Diversification can enhance safety, but it's not a guarantee against losses. Managing volatility is a key part of investing in Bitcoin. In 2026, tools like stop-loss orders, options, and futures contracts allow investors to hedge against price swings. These financial instruments can help limit losses, but also require knowledge and experience to use effectively. Proper volatility management can make Bitcoin a safer investment, but it's important to understand the risks involved. Bitcoin can be approached as a long-term investment or a short-term trading asset. Long-term holders, or hodlers, believe in Bitcoin's future value and are less concerned with short-term price fluctuations. Short-term traders seek to profit from volatility. In 2026, both strategies are common, but each carries different risks and rewards. Understanding your investment horizon is crucial for determining whether Bitcoin is a safe choice for you. Investing in Bitcoin can be an emotional roller coaster. Price swings can trigger fear, greed, or panic, leading to impulsive decisions. In 2026, investor education and experience have helped some manage these emotions, but psychological factors still play a big role. Staying disciplined and sticking to a well-thought-out plan is essential for investment safety. Media coverage can have a significant impact on Bitcoin's price and perceived safety. Positive news can drive demand, while negative stories can trigger sell-offs. In 2026, social media and online forums amplify these effects. Investors should be cautious about reacting to headlines and focus on long-term fundamentals instead. Bitcoin enables peer-to-peer transactions without the need for intermediaries. This feature enhances privacy and reduces transaction costs. In 2026, peer-to-peer trading platforms are more user-friendly and widely used. However, these transactions can carry risks, such as fraud or lack of recourse in disputes. Understanding how to safely conduct peer-to-peer trades is important for protecting your investment. Bitcoin's global nature makes it ideal for cross-border payments. In 2026, businesses and individuals use Bitcoin to transfer value internationally, bypassing traditional banking systems. This can reduce fees and increase speed, but also introduces regulatory and compliance challenges. Understanding the benefits and risks of cross-border Bitcoin transactions is key for international investors. In many developing countries, Bitcoin offers an alternative to unstable local currencies and limited banking infrastructure. In 2026, adoption in these regions has grown, providing financial inclusion for millions. However, challenges such as internet access, education, and regulatory uncertainty remain. The impact of Bitcoin in developing economies is an important factor in its overall safety and potential. Central banks worldwide are developing their own digital currencies, CBDCs. In 2026, several countries have launched CBDCs, offering digital alternatives to cash. While CBDCs compete with Bitcoin, they also validate the concept of digital money. The coexistence of Bitcoin and CBDCs raises questions about future regulation and adoption. Investors should watch how CBDCs influence the crypto landscape. Privacy is a double-edged sword in the Bitcoin world. While transactions are pseudonymous, they are also recorded on a public ledger. In 2026, privacy-focused upgrades and tools have improved user anonymity, but regulatory scrutiny has increased. Balancing privacy and compliance is a challenge for investors who value both security and legality. Quantum computing poses a potential threat to Bitcoin's cryptographic security. In 2026, quantum computers are not yet advanced enough to break Bitcoin's encryption, but the risk is on the horizon. Developers are already researching quantum-resistant algorithms to future-proof the network. Investors should be aware of this emerging risk and follow developments in quantum technology. Bitcoin's development is guided by a global community of developers, miners, and users. Decisions are made through consensus, which can be slow, but helps maintain decentralization. In 2026, community governance remains a strength, ensuring that no single entity controls the network. However, disagreements can lead to forks or delays in upgrades. Understanding how governance works is important for assessing Bitcoin's resilience and safety. Investor education has improved significantly by 2026. Resources, courses, and communities help newcomers understand Bitcoin's risks and rewards. Increased awareness reduces the likelihood of costly mistakes and scams. However, misinformation still exists, so it's important to rely on reputable sources. Education is a key factor in making Bitcoin a safer investment. Financial advisors now play a larger role in guiding clients on Bitcoin investments. In 2026, many advisors are certified in digital assets and can help investors navigate the complexities of crypto markets. Professional advice can improve safety by ensuring proper risk management and compliance. Choosing a knowledgeable advisor is an important step for those new to Bitcoin. Insurance products for Bitcoin have become more common in 2026. Some custodians and exchanges offer insurance against theft or loss, providing an extra layer of protection. While insurance can enhance safety, it's important to understand the terms and coverage limits. Not all risks are covered, so investors should use insurance as part of a broader risk management strategy. Bitcoin is often promoted as a hedge against inflation. In 2026, persistent inflation in some economies has driven more investors toward Bitcoin. Its fixed supply makes it attractive compared to fiat currencies that can be printed at will. However, Bitcoin's price can still be volatile, and it may not always move in line with inflation trends. Understanding this relationship is important for assessing safety. Having an exit strategy is crucial for any investment, including Bitcoin. In 2026, investors use various strategies, such as setting price targets, using stop-loss orders, or gradually selling over time. Planning your exit in advance can help lock in gains and minimize losses. A well-defined exit strategy contributes to the overall safety of your Bitcoin investment. Let's look at some real-world case studies. In 2026, investors who diversified, managed risk, and stayed informed generally fared better than those who chased quick profits or ignored security. These examples highlight the importance of education, discipline, and a long-term perspective when investing in Bitcoin. Learning from others, experiences can help you make safer investment decisions. Experts remain divided on whether Bitcoin is a safe investment in 2026. Some see it as a revolutionary asset with long-term potential, while others warn of ongoing risks and volatility. Listening to a range of expert opinions can help investors form a balanced view. Ultimately, the decision to invest in Bitcoin should be based on your own research, risk tolerance, and financial goals. So, is Bitcoin still a safe investment in 2026? The answer depends on your perspective and risk tolerance. Bitcoin has matured, with improved security, broader adoption, and greater market infrastructure. However, it remains volatile and subject to regulatory, technological, and market risks. By staying informed, managing risk, and investing responsibly, you can make Bitcoin a safer part of your portfolio. As always, do your own research and consult with professionals before making investment decisions.